The current price for Plug Power Inc., trading under the ticker symbol PLUG on the NASDAQ, is $2.52 USD, representing an intraday increase of 0.12 USD or 4.77% as of today, January 28, 2026. While a nearly 5% jump usually signals a celebration for most growth stocks, the atmosphere around this hydrogen pioneer is thick with a specific kind of tension that most retail investors haven't fully grasped yet. Most people are looking at this green candle as a simple recovery or perhaps a reaction to the broader market momentum, but the real story is much more clinical. The reality is that this price movement is happening against the backdrop of a massive looming decision regarding share authorization that could literally double the number of shares in existence. When a stock climbs right before a potential massive dilution event, it is often less about organic demand and more about a high-stakes tug of war between short sellers covering their tracks and speculative traders trying to front-run a meme revival. The common belief right now is that Plug Power is finally turning the corner because they just finished a 100-megawatt electrolyzer installation at the Sines Refinery in Portugal. It looks great on paper. Execution at scale, a foothold in Europe, and a tangible piece of infrastructure. However, the deeper take you need to consider is that the cost of these wins has been astronomical. We are looking at a company that is essentially running a race where the finish line keeps moving further away, and they're asking you, the investor, to buy them a new pair of shoes every few miles. While the market sees a 4% gain today, the institutional reality is a frantic scramble to secure enough capital to survive the next 12 months without the company's bank account hitting zero. If you look at the recent daily swings, the volatility has been relentless. We've seen Plug Power bounce between the low $2 range and mid $3 marks with almost no regard for traditional valuation metrics. This isn't just noise. This is the result of a massive shift in how the individual brokerage community and big institutional players are viewing the hydrogen sector. Trading volumes have spiked recently, often exceeding 100 million shares a day, which is massive for a company with this market cap. Much of this activity is being driven by the anticipation of the Special Meeting of Stockholders scheduled for tomorrow, January 29, 2026. Management is pushing for an increase in authorized common stock from 1.5 billion to 3 billion shares. Think about that for a second. They want the power to double the supply. In any other industry, that would be a death knell, but in the world of green energy speculation, some traders are interpreting this as a necessary evil to clear the runway for their Project Quantum Leap. Institutional activity has been a mixed bag of quiet exits and aggressive hedging, while some smaller funds like Duff & Phelps and Mirae Asset have actually been increasing their positions. The heavy hitters are playing a much more dangerous game with options and short positions. If you're using investing sites to track the smart money, you'll notice that the short interest remains incredibly high. This creates a coiled spring effect. Any bit of marginally good news, like the CEO doing a Reddit AMA or a small contract win, sends the shorts running for the exits, which pumps the price temporarily. That is likely what we are seeing with this 4.77% move today. It's not necessarily a vote of confidence in the long-term cash flow. It's a tactical squeeze in a highly liquid environment. The sector momentum is working in weird ways. While we see Nvidia stock or Apple stock moving on earnings and AI cycles, Plug Power is tied to the macro of the energy transition. Lately, the hydrogen space has felt the pressure of high interest rates and the slow rollout of government subsidies. Even with the One Big Beautiful Bill Act providing tailwinds, the execution risk is what's keeping the price suppressed. Investors who are self-investing through platforms like Robinhood or SoFi Invest are often caught in the middle of these institutional battles. They see the buy the dip narrative on social media, but don't see the massive cash burn happening behind the scenes. Last year alone, Plug Power burned through hundreds of millions of dollars, and while they claim they will be EBITDA positive by the second half of 2026, the market is skeptical. The expectation is a green future, but the reality is a red balance sheet. Let's talk about the business itself for a moment, because it's easy to get lost in the tickers. Plug Power isn't just making a single product, they are trying to build an entire ecosystem. They make fuel cells, they build electrolyzers to create hydrogen, and they operate the infrastructure to transport it. Their GenDrive fuel cell systems are actually used by giants like Walmart and Amazon in their warehouses. If you've ever seen a forklift moving silently through a massive distribution center, there's a good chance it's running on a Plug Power system. This is a real business with real customers. The older reports show they have deployed over 72,000 fuel cell systems and hundreds of fueling stations. They are the largest user of liquid hydrogen on the planet. But the problem has always been the cost of goods sold. For a long time, it cost them more to make and deliver the hydrogen than they were getting paid for it. They were essentially subsidizing their customers' green transitions. The strategic pivot they are calling Project Quantum Leap is their attempt to fix this. They are trying to move away from being a growth-at-all-costs company to one that actually cares about margins. They've been cutting headcounts, reducing operating expenses by over $200 million, and focusing on high-margin projects like the Sines Refinery. They're also looking at providing backup power for data centers, a huge market right now because of the energy demands of AI. This is where the narrative gets interesting. If Plug Power can successfully position its fuel cells as the green alternative to diesel generators for the massive data centers being built by the tech giants, the valuation could look very different in 3 years. However, the risk of dilution is the elephant in the room. When a company doubles its authorized shares, the piece of the pie you own gets smaller. It's a classic case of the expectation versus reality trap. The expectation is that the new capital will fund the growth that leads to profitability in 2028, but the reality is that the market often penalizes this kind of move by dragging the price down to reflect the new share count. If you're using Interactive Brokers or the Fidelity trading platform, you need to be looking at the shares outstanding metric as much as the price action. This is a battle of survival. Comment below how many shares of Plug Power you currently hold and whether you plan to vote yes or no to the share increase proposal tomorrow. I'm genuinely curious to see where this community stands on the dilution versus growth trade-off. The macroeconomic pressures cannot be ignored either. We are in a higher-than-longer interest rate environment, which is brutal for companies that need to borrow money to build factories. Plug Power recently secured a $525 million credit facility, but the terms are rarely in the company's favor when they are in a position of weakness. This is why you see so many hold or sell ratings from analysts at places like BMO Capital or TD Cowen. They are looking at the cash runway. With less than a year of cash on hand, Plug Power is basically a high-stakes science experiment that is currently being peer-reviewed by the most ruthless critics in the world, the bond and equity markets. Now let's pivot to the future outlook. There are two primary scenarios here. In the bull scenario, Plug Power successfully raises the capital, the Sines project proves that green hydrogen can be produced at scale and at a profit, and the company hits its target of being operating income positive by 2027. If that happens, today's price of $2.52 will look like a gift. The bear scenario is that the dilution is just the first in a series of emergency capital raises, the data center market chooses a different technology, and the company continues to bleed cash until it is forced into a restructuring. The tension between these two outcomes is what makes Plug one of the most debated stocks on any investment app or online investing forum. When you analyze the daily movement of $2.52, you are seeing the expectation of a successful shareholder meeting. People are betting that the authorization will pass, the company will get its cash, and the uncertainty will be removed. But the reality is that the fundamental problem of negative gross margins hasn't been fully solved yet. They are making progress, moving from a negative 66% margin towards a neutral goal, but neutral doesn't pay the bills or reward shareholders. It just means you've stopped losing money on every unit sold. To wrap this up, the contrast between the market's narrative and the financial reality of Plug Power is as stark as it gets. On one hand, you have a global leader in a sector that is vital for the future of the planet. On the other, you have a company that has destroyed a massive amount of shareholder value over the last 5 years and is currently asking for a blank check to continue its operations. The 4.77% gain today is a tactical move in a much larger game. Whether you were using Schwab Intelligent Portfolios for a hands-off approach or managing an individual brokerage account on Robinhood or Fidelity, you have to decide if you believe in the inflection point or if you think the quantum leap is just a jump into a void. In summary, the central insight here is that Plug Power is no longer just a green energy play, it is a capital structure play. The technical execution in Portugal is a milestone, but the financial execution in the boardroom tomorrow is what will dictate the price action for the rest of 2026. The expectation is a turnaround fueled by new capital, but the reality is a company that must prove it can produce $1 for less than it costs to make one.